One of the things I think we're going to look back on the late 2010s and early 2020s as a really crazy period for the electric vehicle industry and the way that we're valuing these companies. The historical period to compare to for electric vehicle manufacturers is really the 30s, 40s, 50s. This is when the modern auto market was really developed, when companies like GM, Ford, Chrysler built their power in the market. But what we don't remember is that these were some of the most valuable companies in the world at that time, and most of their competitors went bankrupt or ended up being acquired. And then all the surviving companies had a hard time making money or generating any sort of consistent shareholder returns over the next few decades. General Motors even went bankrupt during the financial crisis. So why is it the auto industry has been so difficult for companies to make money? It's been such a poor investment for investors. And then suddenly we're going to have tons of electric vehicle manufacturers who are going to suddenly buck that trend and be incredibly profitable, generating 20, 25% margins, high profits that justify these tens of billions or hundreds of billions of dollars in valuation. I think we're learning the answer right now. And the answer is that things are going to be exactly the same this time around as they were last time. Electric vehicle companies are manufacturing companies, just like legacy auto companies have struggled because they are manufacturing companies. They have to deal with supply and demand. They have to deal with labor. They have to deal with material costs. It is a very difficult business, and EV companies are finding that out right now. So I want to go through some historical context and why I think a lot of EV companies are still incredibly highly valued, including two extremely popular ones, Tesla and Rivian. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. I want to start with a chart that just shows the price to sales multiple of 4 of the bigger auto manufacturers in the US. In blue, you have Tesla. Green is Rivian. So price to sales multiples of 6 and about 2 to 3 respectively. If you go to the legacy automakers, GM and Ford, you're looking at price to sales multiples of 0.3. So the price to sales multiples are about 10x for the electric vehicle auto manufacturers. The next thing to look at is the gross margins for these businesses. Now, Tesla has had a higher gross margin than a lot of traditional automakers over the past couple of years. That started really during the pandemic when production for vehicles dropped like a rock, and Tesla was the one company that was increasing their production. They could price vehicles extremely highly. That was when they were generating margins in excess of 25%. But that has not maintained. Margins in the most recent quarters are in the high teens, and I think that's going to probably come down in 2024. We have learned just over the last couple of weeks that a price war in China specifically has taken its next step. Tesla was discounting vehicles by as much as $5,000 just last week. So we're probably going to see those margins continue to come down. I wouldn't be surprised if Tesla has a higher gross margin than some of the traditional automakers, but it's not going to be a 25% gross margin business long term. And a lot of the technology revenue that a lot of investors have been talking about just hasn't materialized. FSD is not a significant business for them yet. And even something like energy storage is always going to have margins that are more analogous to energy margins or manufacturing margins than they are to technology margins. Energy storage is not going to be an 80% margin business. It's going to be a highly competitive business because it's a manufacturing business, and there's dozens of suppliers around the world who are trying to get into that business, and that's going to push margins down. Again, we go back to the fact that these are manufacturing businesses that are driven by supply and demand. As supply for all of these products goes up, if demand doesn't follow on the same curve, you're going to see companies compete with each other based on price. So once you start seeing discounting or price reductions in a market like electric vehicles, that is when you're going to start to see financial problems for these companies. So that's exactly what we started to see in 2023. And what's happening in 2024 is these challenges are getting worse. Companies are introducing more electric vehicles. We have seen that with BYD in China. We've seen that with Rivian announcing the R2 and the R3. Tesla is now producing the Cybertruck and is supposedly going to make another lower cost vehicle. So we're going to have more supply coming onto the market, just as buyers are kind of shying away from electric vehicles, or at least the growth that we had over the last decade. And if that supply and demand balance gets out of whack, that's when companies really start to report losses and get into financial trouble really quickly. This has always been the challenge for automakers. This is not a new challenge. This is something that Ford, General Motors, Chrysler, Jeep, all of these brands have gone through in the past. That's why there's only a handful of big automakers. And that's why a company like Toyota with the Toyota production system in the 1980s and 90s could have even a small advantage in their efficiency in their products, and they suddenly make far more money than a lot of their competitors because they're just that little bit more efficient. And as you have low cost competitors, particularly in China, come in, they're going to be a little bit more cost effective, have a little bit more government subsidies than Tesla could get. And that's what's going to crush the margins in the industry. We saw this in the solar industry. I think this is the biggest comparison that we can have, is that solar manufacturers, whether they were in the US or Europe or even China, when China decided to increase supply and produce as many solar panels as they could at a really low price, it just destroyed the value in the industry. And that's what investors are paying for now, is the future value that these companies are going to be able to generate. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. So what are the signs that we should be looking for that a company is succeeding or not in electric vehicles? First one is going to be gross margins. Is the company have gross margins that can be in excess of some of the legacy automakers? Tesla has obviously proven that they can do that. Those margins are coming down, so we'll see where that trends. Rivian hasn't been profitable yet. Fisker hasn't been profitable yet. Most of the other automakers have not proven that they can generate a positive gross margin, much less a teens or 20% gross margin. The next thing we're going to need to look at is scale. Do you have the scale that is going to be able to allow any sort of margin or pricing power? Because if you can't make 500,000 or 1 million vehicles, you're just simply not going to be able to compete with these bigger automakers. Even though companies like GM and Ford have delayed some of their investment in electric vehicles, they are still making multi-billion-dollar investments every year in developing electric vehicles, in building out manufacturing plants, in building supply chains. And so when they come to market with more and more vehicles, that's going to be the competition that you're going to have to beat. And a lot more of these companies are competing on price. So if you have scale to your advantage, if you're one of these legacy companies that can just make 1 million or 2 million vehicles at a relatively low cost, like they can with internal combustion engine vehicles, that's going to be an advantage over a company that's making a couple 100,000 vehicles. I think that's fundamentally the challenge with Rivian right now, is they just don't have enough scale to get to profitability. And the problem is that investors are paying a premium for companies that have never deserved a premium on the market. Auto manufacturers have typically not been the kind of companies that can generate consistent profits. That's why their stocks trade for relatively low price to earnings multiples in the mid-single digits for companies like Ford and GM today, and very, very low price to sales multiples. Like I said, about 0.3 for all of these companies right now. Right now, you're paying in excess of 10x more than that for almost all of these electric vehicle manufacturers. And I think that alone makes all of them overpriced. And I wouldn't be surprised if we see a massive pullback in electric vehicles, even though electric vehicle sales themselves are going to go up. That doesn't mean the profitability is going to go up along with it because of these dynamics in supply and demand. We saw this in the solar industry. The solar industry has grown like absolutely crazy, and the value of solar stocks dropped like a rock between 2010, 2012, and 2017 or 2018. So growth in the industry does not necessarily mean the stocks always go up. Something to keep in mind. History tells us that auto companies are not going to be some of the most valuable companies in the world. You're just going to want to own companies that are going to be able to make a consistent profit. And this is one of those cases where I think everybody thinks it's different this time. And if you look at the supply-demand dynamics in EVs today, we're proving once again, this time is exactly the same as we have seen before in the auto industry. But what do you think about auto stocks and EVs in particular? Leave your comments in the comments section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.